Okay, here we come in with the next video, Understanding Multifamily Financial Statements, the expenses portion of the income and expense statement. Now, the beautiful thing about this is that there are going to be three parts to this video. I'm going to explain it very, very succinctly. When you're done this video, you will have such a great understanding. The whole series of this month's teachings, you'll have such a great understanding of how the multifamily financial statements work, how the sellers try to bamboozle you, and how you can protect yourself and sound like an expert. The first thing I want to go through are just the general categories of expenses. I could spend an 8-hour-long video going through every category of expenses. I'm not going to do that. I am just going to focus on the general categories, the ones that we use on a regular basis. As I open my water, that we use on a regular basis, and all of the other categories will fall under these broad categories. And my rules of thumb that I'm going to give you are all based upon the broad categories, not on the specifics, okay? The next thing I'm going to do is go over, every time I go through a category, I'm going to go through a rule of thumb. Now, you are going to need to commit these rules of thumb to memory, all right? So that when you look at a particular property and you look at the financial statements, you will know if the person's expenses for that particular category are in the range of the rules of thumb. Now, keep in mind that the rules of thumb can be kind of broad because you need to understand every property is essentially a living, breathing entity. And so a living, breathing entity is at different stages of its life cycle, so therefore it's going to have different rules of thumb for different cycles. And you just need to understand where that particular property is in its cycle. And I'll explain that as we go on. And then finally, the most important thing are the expense ratios. You can determine if the financials on a particular property are legitimate within 30 seconds of looking at the income and expense statement when you understand the expense ratios. So over time, you will have the rules of thumb and the expense ratios committed to memory. I know exactly what they should be. I've been dealing with them for so long. I know exactly what the expense ratios for property should be. I know exactly what the rules of thumb for different categories of income. Oh, shoot. I see a typo here. Categories of income. It's actually categories of expenses. My bad. Oh, I'm so sorry about that. Okay. Glad I caught that. That will not be fixed on the editing room floor. I'm just going to gloss right over that. You'll understand. Okay. Now, two types of expenses. And I've had this conversation with my accountant. He didn't know what I was talking about because he doesn't categorize expenses this way. You have the non-controlled expenses, which are things like taxes and insurance. And then you have the controlled expenses, which essentially is everything else. Now, my accountant has never categorized things this way, but I have seen income and expense statements where they break it down in these two categories. You cannot control the taxes, you cannot control the insurance, but all the other expenses can be controlled, meaning you can make the determination whether you're going to pay it or not. And you might think to yourself, well, you don't have to buy insurance. Well, you know what? Typically, if you have a mortgage on the property, the bank requires you to buy insurance. So that's a non-controlled expense. So let's take a look at the non-controlled expenses. Now, taxes. You have to understand the calculation of the taxes in your marketplace. So if you're looking to buy property in a particular location, you should have had a conversation with the tax assessor's office as to how they calculate taxes, how often taxes are billed, how many times do you have to make your tax payments every year. You should go and make sure you have that conversation because you want to be incredibly knowledgeable as an investor in that marketplace as to how the taxes are calculated. Now, you also have to understand whether it's a disclosure state or a non-disclosure state. Now, for those of you that don't understand what that means, hold on, I'm going to back up here a little bit. Let me jump down here to previous. For those of you that don't know what that means, a non-disclosure state means that the seller, when they sell a property, and the buyer, when they buy it, they do not have to disclose the sales price to the tax assessor. And the assessment value is based upon the purchase price. So the tax assessor may have the absolute wrong number for what the value of the taxes are. And if you just bought that property and you based your analysis on that wrong number, then you're going to really hurt yourself. Let me just stop you here and say that there is one of the early coaching calls in the archives has to do with property taxes. And I do a complete analysis of the property taxes in Texas, it happens to be, which is a non-disclosure state, and it is a great education for you in determining the difference between a disclosure state and a non-disclosure state. So I recommend that when you're done this video, if you have not watched that group coaching call in the archives section, you go and do it. It is a phenomenal group coaching call, and you will come away totally getting it as far as how you can be bamboozled in Texas, even though you think you're getting yourself a steal. So make sure that you understand the difference between the disclosure state, the non-disclosure state, and how the taxes are calculated in your marketplace. All right, so let's move on to one of my most favorite topics, insurance. All right, before you get started, like you did with a tax assessor, contact an insurance agent to get the cost per unit in that marketplace. You want to know going in there, what is a typical cost per unit that I'm going to have to spend when I'm looking at insurance. Now, the rule of thumb is typically $250 per unit per year, but it is very, very geographically driven. Here's what I mean. Oklahoma City, I've seen rates at $180 per unit per year. 2 streets back from the ocean in Fort Lauderdale, Florida, I've seen $600 per unit per year. So it is very, very geographically driven. And you want to speak to your insurance agent, and you want to use the number that they give you whenever you're doing analysis. If your insurance agent comes back and says, oh yeah, it's going to be about $250 per unit per year, and you look at the income and expense statement from the seller and he's showing it at $180 per unit per year, what are you going to use? You're going to use your insurance agent's number. Here's why. You have no idea. You have no idea what that seller's policy is like. You have no idea if it covers everything it's supposed to cover. You have no idea if the guy's got a $100,000 deductible because he's trying to save money. You have no idea if the guy owns a bunch of other properties and he's got a blanket policy on all of them, and so therefore, this one particular property is taking advantage of some great rates somewhere else. You have no idea what this guy's insurance cost is, how it's derived. So use the number that your insurance agent gives you to use, okay? Now let's talk about controlled expenses. First off, utilities. Now let's get some terminology straight here. Is it a tenant-paid property, or is it an all bills paid property? Okay, understand what that means. Tenant paid means that the tenants pay the utilities. All bills paid property means that you pay the utilities. All right, so the tenant just comes here, writes one check every month for his rent and his utilities, and you are responsible for paying the utilities. I'm telling you, some of the folks, I don't know what you're looking at, I don't know what type of deals you're looking at, but I will never again in my life ever own an all bills paid property. Never. Whenever your tenants are in partnership with the utility company against you, you will lose every time. I remember having an all bills paid property down in Texas. They had in-wall air conditioning units. I was walking around the property. It was 110 degrees outside. I was listening to every single air conditioner going full blast, and I thought to myself, I am not going to make a dime this month because of the utility bill. And I was right. So understand the terminology. Is it a tenant-paid property, or is it an all bills paid property? Now, if they do some type of a utility bill back, what that means is that you as a landlord are receiving income from your tenant in the form of a utility income to help defer the cost of the utilities. You never make as much money on the income from your tenants as you will pay out in the expenses for the utilities. but the best I've ever seen is 50-50. So in other words, if your utility bills on a month are $1,000, the best I've ever seen from utility income is $500. All right, typically it's a third, 2/3. And the way to tell that is when you look at the income and expense statement, the first thing you're going to do is look at the income section. I think I mentioned this in the income section, income video. When you see the utility income, your eye should automatically drop down to the utility expenses and see the difference between the two numbers. How much money are you actually losing on that deal? All right. Now, the rule of thumb is okay. This is actually off. Here's a typo, another typo. I apologize, folks. Make sure that you catch this. Typically, for the rule of thumb for an all bills paid property is about 100 units, $100 per unit per month for an all bills paid property. Okay, on a tenant paid property, it's typically $100 per unit per year. All right. So my mistake here. I apologize for this. I'm going to probably try to put a little caption as we go through this so I don't have to go back and redo the whole video. But just understand that's typically what you see. About $1,000 to $1,200 per unit per year for an all bills paid property. That's how much it costs. It ain't cheap. Utility, especially if you have a gas and electric property. Typically, when you're down in Florida, you just see electric, and what you'll see with other parts of the country, you'll have a gas and electric bill. You can definitely see it between $1,000 to $1,200 per unit per year for the rules of thumb for the utilities. That's why I don't buy all bills paid property. It's just way too expensive. Okay, next. Now we're getting into the advertising and the marketing. Remember at the beginning of this video, I talked about different properties being in different life cycles. And the advertising and the marketing budget is something that you can look at the expenses for this particular category, and then you can really figure out what's going on the property. Here's what I mean. The rule of thumb for the advertising is between $25 to $100 per unit per year. All right. Now, what that means is that you've got a pretty big swing here between the 25 and the 100. Let me just throw in a little caveat here. My marketing expenses are virtually zero on my properties because there are so many ways that you can advertise for your units absolutely free. So my marketing budget is very, very low. But that's typically because I have a very high occupancy, so I don't have to spend a lot. If you are looking at a property that has high occupancy, the rule of thumb should be closer to the $25 per unit per year for the marketing. If you're looking at a property that has a occupancy problem, you're looking at a rule of thumb closer to the $100 per unit. I one time looked at a property that had 95% occupancy and they were spending $200 per unit per year for the marketing. That didn't make any sense to me. Once you get to about a certain maximum level, even above the market threshold for occupancy, what do you need to spend marketing money for? You shouldn't be spending that kind of money. That didn't make any sense whatsoever. I thought the guy might have had a crush on the apartments.com sales rep or something, because it just didn't make any sense that it was spending that kind of money. But when you look at that number should tell you where the property is in its life cycle. And it should give you an idea as to what the occupancy is on that particular property. And if the numbers don't jive, I mean, if you've got low occupancy, 50% occupancy, and you're only spending $25 per unit per year for the marketing, that's a problem. That's bad management. So just keep that in mind when you're looking at it. Now, property management. We all know this, and here's my biggest rule about property management. Always, always, always include this expense. If you're looking at a property that is self-managed and they decide, oh, we self-manage, we don't have to charge a property management fee. When you go to do your analysis, you put that property management fee in there. If you don't, think about what you're doing. You are increasing their net operating income because you are not building in the proper expenses. So right away, by increasing their net operating income, you've increased the value of the property. You're now paying more for the property and giving them more money because they're not paying themselves a property management fee. Whose fault is that? Why should that cost you more money? So always, always, always include this expense in your analysis. Now, it should be between 4 and 8%, depending upon the size of the property. Typically, and I think I might have put this in here, if the broker says 3%, budget for 4. So many times a broker will come back and say, oh yeah, well, we can get a good property management fee in here at 3%. Okay, fine, I'm gonna use 4. Because you always want to be conservative, and they're always going to tell you the rosiest case, and you're better off just being more conservative when you're talking to a broker about the numbers. I said it should be about 4 to 8% depending upon the size of the property. The much larger property is going to have a smaller management fee. Smaller properties are going to have higher. I mean, if you're looking at about a 10 unit, you can expect about a 10% property management fee. And the question I have down here is a percentage of what? All right, now that is a key question, and that's something that you're going to need to have answered when you're negotiating with a third-party management company. What do they get to keep a percentage of? All income? Rental income? Late fees? Do they get to keep late fees? A percentage of late fees? Do they get to keep a percentage of the laundry income? That's what you're going to negotiate with your property management company. So always ask the question, it's a percentage of what? And when we do our analysis, we use that it's a percentage of the rental income. So just the income off the rents. All right. Now, next category is repairs and maintenance. This is another very, very telling category that will help you understand where the property is in its life cycle. Remember, these repairs and maintenance expenses are not for capital expenditures. And in my classes, I like to use the example of paint. Is paint a repair and maintenance item, or is it a capital expenditure? And the answer is, well, it depends. If it's an exterior paint, it's capital expenditures. If it's interior paint, it's repairs and maintenance. All right, so that's the category that it would fall under. So you always want to make sure that you're categorizing the supplies and the repairs and maintenance items correctly, and that they're not falling under the capital expenditures column. This is the best way to describe what repairs and maintenance is that this is what your maintenance man spends every time he runs to Home Depot or Lowe's. Every time a unit needs something, he jumps in his car and he drives down to Lowe's and he buys it. And that item gets itemized and put into this repairs and maintenance section. So that's typically what you're seeing. The rule of thumb. Now understand, look at the big spread here on this rule of thumb. It's between $400 and $900 per unit per year, depending upon the age of the property, the quality of the asset, and you have to understand the corresponding payroll expense to this number. Let me explain what I mean by this. If you're dealing with a Class A property, one that's within the first 10 years of its life, they're not going to have much in the way of repairs and maintenance. Everything is working well on that property. So you're looking at the $400 range. All right, that's what you should expect for the repairs and maintenance rule of thumb. If you're looking at an older, tired Class C property that is, everything is breaking on it, you're looking at the $900 per unit per year fee. Okay? So that's the difference between the rules of thumb, the 400 to the 900. And it all has to do with the quality and the age of the asset. And so if you're looking at a Class A property that has $900 per unit per year, there's something wrong there. What the heck are they spending $900 per unit per year on a Class A property? They might be categorizing the numbers wrong. They might be categorizing what should be capital expenditures in the repairs and maintenance section. Well, if that's the case, they're idiots, because they're driving down their own net operating income and reducing the value of their property. So these are the types of things you want to keep in mind when you're looking at it. Now let me explain this last bullet point regarding understanding the corresponding payroll expense. What do I mean by that? Well, if you are dealing with a Class C property and your maintenance guy is spending $900 per unit per year on repairs and maintenance, one guy cannot do that all himself. So that means that your payroll, your staff, has to be larger. And therefore, there should be a corresponding increase in the payroll. And that's part of the problem with these older C-class properties. The expenses on them can get out of hand very quickly. If you've got a lot of repairs and maintenance that you have to do, you're going to have a lot of expenses in that category, but you're also going to have a lot of expenses in the payroll category as well. So when you see a large repair and maintenance number, you had better see a large payroll expense as well, because somebody is spending that money, and they better be on the payroll. All right. Now, general administrative, this is really easy. This is just the costs for running an office. A lot of times you can have other types of things thrown in here as well, but I like to keep it down to just pretty much running the office, the copier leases, the cell phones, the office supplies. Typical rule of thumb is $100 to $400 per unit per year. You might think to yourself that's kind of a big spread, but it depends upon the size of the staff. If you're looking at a property that's got a leasing office, and you've got 2 leasing agents, and you've got a property manager and a secretary, yeah, you're looking at the $400 per unit per year cost, because there's a lot of people there that are using those supplies. So that's something you need to take into consideration. And other times, if you're dealing with a small property that the leasing is done by picking up the phone and calling somebody, and they'll meet you at the building at 6 o'clock at night, your general administrative expenses are going to be next to nothing, because there's nothing for them to do. So that's just something to keep in mind when you're looking at the G&A. We call it G&A in the business. Okay, payroll, huge. All right, you have to first understand how many units there are. Typically, the rule of thumb that I like to use is I have 2 employees for every 150 units. That's kind of pushing it. Sometimes you might think, it's 2 people for every 100 units. I like to try to do the 2 people for every 150 units. There's a maintenance man and a leasing manager. That's all I need. Especially if it's a B-class property. If it's a C-class property, all bets are off. All right. If it's a B-class property, you can do it 2 people for every 150 units. And as I said, as I just mentioned, it all depends upon the quality of the asset as well. Now, the rule of thumb for payroll has always been approximately $1,000 per unit per year is what the payroll expense should be. All right. But that depends upon a lot of things. Like, number one, health insurance. Folks, if you're listening to this video, Obamacare is about to rear its ugly head in full blown out fashion coming up next year. When that happens, this rule of thumb is out the window. A lot of people are going to really start to make the decision whether they can afford to keep health insurance on for their people. And I'm telling you, it's going to be a huge problem for everybody. And so once this Obamacare mandate hits everybody, this is going to be a huge problem. Now, I'm just thinking to myself, here I am telling you what's going to happen in the near future with expenses, and I'm thinking to myself, what happens if somebody listens to this video 10 years from now and they say, oh, listen to that guy talk about Obamacare, and oh, we don't even have that anymore. They did away with that. And I'll tell you something has to give, because these property managers cannot afford to offer health insurance to their people if it's going to go up the way that it's supposed to. So, biggest problem every year. The other rule of thumb happens to be depending upon geography. Now, I've seen certain areas like way south Texas, El Paso, and down Brownsville, that area. You can see some really low payroll expenses, and you get up in New Jersey, and it's outrageous. So it really has to do with the geography. Just like the insurance, you've got to understand the market that you're in and what the actual cost should be in those areas. And also, you got to think about part-time and full-time. Are you going to keep people on part-time? Are you going to keep them on full-time? Are you going to offer them benefits? That type of thing comes into play. Okay, enjoying my water. Now, the next thing have to do with contract services. Now, keep this in mind. There are certain things in here that you just have to hire contract services for. You got landscaping. It's easier to have a guy come in and do the landscaping. Garbage, they come and pick it up and take it away. If there's a pool, you want to look to see if there's a pool contract service that comes in and takes care of the pool, or does your maintenance guy do it? Does a building have an elevator? If it does, it should have an elevator contract. You don't want to have to deal with that on by yourself on a Sunday morning. Professional fees, those would include the accounting fees and legal fees, and then et cetera, et cetera, et cetera. There's so many different things that you can throw in here. Broad rule of thumb is $400 per unit per year. That is being very generous. You have to really look at the property and determine what contract services do you need and which services can be done in-house. It's always cheaper to do it in-house. But there are many things that just cannot be done in-house, such as the professional fees or the elevator or what have you. Pool you can, garbage you can't, landscaping you can. So I one time I took over a property, and my third-party contract services number was over the top. 400. It was closer to 1,000. And I really had to figure out what was going on. What happened was I had taken over the existing management company. And kept the same people on board. And whenever the maintenance guy needed anything done, he just had everybody on speed dial. He would just hit a button, and somebody would come over and fix it, and would have to pay for it. I don't need to pay this maintenance man to be an operator. I needed him to fix the place, and so I got rid of that guy and brought in a maintenance man who was certified in certain things, was well qualified, and you should have seen my contract services number come way down after that. He was able to do many things in-house, and that's the way you do it. If typically if you're running the properties and they have to call out to a third-party contractor to have something done, you make sure that they have to get permission first before they do that. So, all right, my favorite part: expense ratios. So we've gone through the different categories of expenses. We've gone through all the different rules of thumb for them. Now we're coming up to expense ratios. Folks, here's how you're going to use expense ratios. When you get your income and expense statement, the first thing you look at is the expense ratio. The very first thing you look at is the expense ratio. Now, I am giving you a very light course here on expense ratios. I mean, if we're all CPAs, we would break this down even further. But I have found that just using these rules of thumb, have worked perfectly, and I recommend you do the same. So the first thing you're going to do when you get an income expense statement is you're going to look at the expense ratio. So let's understand exactly what it is, because you can evaluate a property in 30 seconds if you know the expense ratios. Now, what I want you to understand is the expense ratio are the total expenses divided by the total income. That's your ratio. That's all you got to do. A lot of times the income and expense statements that they give you will have that number already down there for you. So you don't even have to break out your calculator. But if you do have to break out your calculator, these are the two numbers you're going to grab. The total expenses divided by the total income. That's your expense ratio. All right? Now, what does it mean? Here's how it works. Now, this is a type of information you're going to commit to memory. If you're looking at a Class A property, the typical rules of thumb are between 35 to 45% expense ratio. Now, that's kind of a broad spectrum, all right? Yeah, it is. If you're looking at a Class A property in Bergen County, New Jersey, you're looking closer at the 45% because you're dealing with higher payroll costs, you're dealing with higher taxes, and you're probably dealing with higher insurance, all right? If you're looking at a Class A property in, let's say, Alabama, you're going to look more in the 35% expense ratio. I'm telling you right now, folks, you cannot run a property below 35% expense ratio. You just can't do it. I've seen so many brokers try to blow smoke up my skirt because they say, hey, this property's at a 29% expense ratio. You cannot run a property at a 29% expense ratio. And you might be thinking to yourself, oh, no, Charlie, yes, you can. No, you can't, because the market, the fair market, will not allow you to. And you might think, well, what are you talking about? Remember, the expense ratio is made up of two numbers, the expenses and the income. If the income is so high that you're able to operate a property at a 29% expense ratio, there's going to be a flight of money into that marketplace because that is such a great deal. Money will be flowing into that economy in order to buy up properties because the expenses are so low. And it doesn't happen that way. What happens is your income on the property comes down because you're competing against other apartment owners who don't need to make all that kind of money. So they'll drive their rents down lower and still make a great profit at 35 to 45% expense ratio. So the economy will not allow you to own a property with a 29% expense ratio. Yeah, and the other thing too is, you can actually legitimately have a 29% expense ratio. You just don't incur any expenses. You don't pay your bills. And you report on a cash basis, and guess what? Yeah, you get a 29% expense ratio. But that's not a business. That's a guy that's just not paying his bills. All right, so don't fall for that. Class A property, typical expense ratio between 35 and 45%. Class B, we're looking at 45 to 55 to 60% expense ratio. Let me explain the difference here. Once again, geography has a lot to do with it. But when we get into Class B property, what we tend to look at on Class B are properties that are always going to be tenant-paid utilities, not all bills paid. Occasionally, you'll have a B-class property that slips it in as an all bills paid property. If that's the case, you're looking at an expense ratio closer to 60%. But typically, the Class B tenant pays their own utilities, so you're looking at an expense ratio of between 45 and 55. What's the difference between 45 and 55? Not only geography, but also the age of that Class B property. The older the property, the more repairs and maintenance you're going to have, the higher the expenses are going to be, the closer to the 55% expense ratio you're going to see. Okay? So use those numbers for Class B. Now, if it's Class C, you're looking at 55 to 75%. Typically 65 to 75% for Class C. And understand why. Class C properties are almost predominantly all bills paid tenants. You're paying the utilities. You're dealing with a much older property. Huge repairs and maintenance. Huge repairs and maintenance means higher payroll. So you're dealing with a property that really the expenses are killing you. And I've seen easily Class C property with expense ratios around 75%. And that really gets to the question is that the type of property you want to be owning? And so if you're looking at a Class C property and the seller is reporting it at 55% expense ratio, be very suspicious, especially if it's an all bills paid property. I've never seen an all bills paid property running around 55% for Class C property. I just don't see it. Okay, now, what do you think the next category is going to be? If you said Class D, you are right. Class D does not have an expense ratio because it has no income. What happens with Class D property is that the expenses exceed the income, so there is no ratio. Essentially, you're dealing with a bombed out shell, you're dealing with a non-performing asset, you're dealing with a full gut rehab repositioning, and so expense ratios are meaningless with a Class D property. You're going in there with your tool belt and your rehab fund, and you're going to turn that property around. So therefore, there is no expense ratio for a Class D property. All right, so commit these numbers. I'm telling you something, folks. The next time you look at a property package and you open up the income and expense statement, go right to that expense ratio and see how I did. I can almost guarantee you that I'm right. You may think I'm being a little wishy-washy. No, I've seen it far too many times. And if the numbers on this spreadsheet, on this page right here, do not match the income and expense section on the property that you're looking at based upon the quality of the asset, well, my guess is that the income numbers that the seller is giving you are wrong. That's why you want to use these numbers, because when you go to own the property, these are the numbers that you're going to be living with, all right? Not the ones that you see in the broker's package. Okay. Whoops, sorry about that. All right, that's the end of our show. And let me just blow this back up again. And that's the end of the expense statement. Folks, I'll tell you right now, if you're in the masterclass program, if you have any questions about this, shoot us an email at info@multifamilyinvestingacademy.com. We're here to help you out every step of the way. By now, you should be going through the offer workshop website. You should be coming on live. And next month, we're going to start teaching you how to draft the letters of intent. We're going to take you through the whole entire analysis of letters of intent, and what to do and what not to do. It's another great lesson. The whole idea is we're building up your confidence, but we're here for you now. So don't even wait. Just start making offers. Make offers today. Thanks, everybody, and we will see you next month.